You are a
Okay, welcome everybody to live valuation. Been a while, been a couple weeks. You guys didn't miss me too much. Give me a moment to double check some settings, make sure everything is working well. Specifically, I need to double check my audio. Nobody's here to tell me if it's working, but I did have to change a bunch of things around, so I need to make sure that I can be heard. Okay, seems like I can. All right, so we got some cool stuff to go through today. That's going to be somewhat of a continuation of some of the things we talked about a couple weeks ago. Um, and hopefully, in some ways, to clarify what I meant by some of the things. The person that spent most of the chat with me in my last show was kind of debating with me a little bit about how useful my new method of research is. So I have some of the, I guess you could say, some progress on that research to show, hopefully kind of clarify what I mean by focusing on quality. Specifically, the person that was listening and chatting with me before was adamant that price has to be paramount, and that you shouldn't pay up for quality assets. And I tried to kind of clarify that was always what I meant, and I definitely didn't mean that we don't take price and value into account. In fact, that's pretty much a prerequisite for investing, in my opinion. But the point is I was trying to describe how it was that I intended to do some more qualitative, subjective work in terms of judging the quality of assets, quality of management for various companies, and how I think that lowers the amount of risk that you experience as an investor. And I've kind of come around to this framework of thinking, frankly, from experiencing a lot of I don't know, I would say necessarily mistakes. Sometimes they're mistakes, but in my own portfolio, I've definitely had plenty of times where I've entered positions, experienced far more pain in that position than I might have expected. Sometimes it still works out for the better anyway, and then sometimes not. But the point is I think that if you focus on other things and start your research from a different point in time, you can kind of get different results. Anyway, I'm getting a little bit ahead of myself. We'll get into that soon enough, but in the short run, let's talk about a few other things. So here's my portfolio, as we usually kind of start off with. There isn't really too much to discuss with that because over the last 2 weeks, I haven't really done too much in my portfolio. Just small nibbles here and there at a few companies. But because I'm actually in the middle of all of this research surrounding different industries, I'm kind of, for the most part, put a pause on all of my stock purchases because I'm trying to see where that research leads me. And the goal at the end of the research is to be in a better position to start concentrating my portfolio a lot more. That's really the goal. That's the real hope. So anyway, like I said, we'll get into that. Before I get too much further, I will say if you're watching the stream live or on the replay, it'd be really appreciated if you could like the stream. That'd really help us get more people to the channel, more people to watch the stream and join us here. Also subscribe to the channel if you haven't already. Scott, yo, what's up? Uh, Figured also, this would be an interesting time to stream. I'm taking some days off in the middle of the week throughout the rest of the year. So I was like, oh, we don't usually get to stream during market hours, so I thought that would be kind of fun too. Here we are. Um, anyway, also, if you have liked and subscribed already, you can also join the free Discord. The link is in the description below, as well as the pinned comment in the chat. Come and be part of our daily discussions of what's going on in the market, what's going on in our own portfolios, analysis of various companies, and stuff like that. And then also there is something new that I just dropped into the chat channel here in the Discord is the link to the public dashboard, which I'll show you here in a moment. But if you want to get access to that, you have to be a member of the Discord server. It is free access. Both the Discord itself is free and that dashboard link is free, but it is only available inside the Discord. So come be part of the server, and then you can get access to that particular link. And if you do join the Discord, it does take anywhere from an hour to a day for somebody to let you in, because it does require manual access to keep spammers and scammers and other such entities out. So just be patient. If you do join the Discord, you won't be able to really see anything initially, but you can ping a moderator or myself, and we'll hopefully be able to get you in relatively quickly. So anyway, let's talk a little bit about the dashboard. Obviously, this main dashboard has been on display for quite some time on the channel. This is really the place where I kind of compile all of my evaluations together in one place, so that I can kind of track what's going on with them, whether or not they're becoming more or less of a bargain on any given day, and see which opportunities are best suited. But it's also a useful tool. You do hear me? Or no? Don't scare me like that. Confirm for me if you can hear me. I thought I checked, but okay. Okay. I'm gonna say, like, I had pulled up in a tab that should have let me hear if it was on, but I want to make sure. I did have to change a whole bunch of audio settings like an hour ago, so that's why I'm really wanted to make sure about that. But I don't know, maybe it's just quieter than usual or something. But anyway, so the point is, I've changed around the dashboard a lot. What with the new valuation template, I figured it would be good to give an update to the dashboard itself, and also the dashboard. um, I had previously had a bunch of different pieces to it, where we had this main page here where it displayed all of the valuations, but I had separate tabs where you could look up the valuations themselves, which I was pretty proud of how that tool worked, but it itself was a little bit clunky just because of the way Google Sheets imports data from other spreadsheets. It's a little bit slow. It doesn't really move that quickly, and sometimes it would have problems with it. So I'd kind of always wanted to find some better workaround to make it work a little bit cleaner. And then also, my original goal with this dashboard was to try to make it available to people out there, whether a public version or a paid version. I kind of had hopes for both of them. But the point is with the version that I had come up with, it had a lot of issues that made it not very easy to update, which meant that if I was going to give people their either a paid or free version of it, then that meant that I would have to update them individually. There wasn't really a very uniform way to kind of update them all at the same time. And that meant that it just really wasn't that feasible to do. So what I did instead is I kind of came up with a different method, where instead of having all of the valuation information imported into this sheet for people to look at, which means you kind of have to update things on an individual basis, I now have actually separate spreadsheets with links at the top that it links to, where it has, like, for example, this is the financials spreadsheet. So here I pull it open, and then here's the income statements for 10 years. Scroll down, there's cash flow statements. Scroll down even further, and there's balance sheets for 10 years. And then this particular tab we're looking at is just for Apple, but down here you can see there's tabs for all of the companies that are on the dashboard. So just by clicking that link, it takes you to a whole separate file, which means it doesn't have to do any importing at all. All of these are just kind of sitting here. I mean, it is importing from somewhere, but it doesn't have to do it in that moment. You know, it doesn't have to do it the moment that you say, I want to look at the financials for this company. It just kind of has them all waiting here already, good to go. And then, like I said, this is the financials one. There's also a link to the valuations here. So you can click on that, and it pulls open a summary page for the new valuation templates that I have, again, with tabs at the bottom for all of the different companies. So you can click here to pull open to see what's my valuation of Amazon look like, what's my valuation of ASML look like, what's my valuation of Home Depot look like, all really just by going to those separate sheets. Now, to clarify, as I was kind of just talking about the public dashboard, this is my personal dashboard right here. You can see right here, it's called the master dashboard. And that's because it's the one that feeds all the information to the other ones. It's the master, the masterpiece, so to speak, which has these links at the top. Now, if we come over to the public dashboard, this is the one that link that is in the Discord there. You'll see that there is no financials or valuation links here at the top. And that's because that is in fact a paid feature. So if you would like, if you, I would say first and foremost, if you have no experience with this at all, like I said, join the Discord, become a member, then go get yourself that link, and then you can enjoy this public version of the dashboard as much as you like. And perhaps after your own experience with it, maybe playing with it for a few days, coming around and checking on it every few days, you're like, oh, wow, I love looking at Minus's valuations here, but I would love to see some of the assumptions that goes into these values right here. Well, then you could choose to become a premium subscriber to the dashboard, which, by the way, is only $5 a month. You can do that at Patreon. You can do that at PayPal. Any of those methods is fine by me. You can really any method. If you want to choose some other way to send me $5, that's your prerogative. Just $5 monthly, and then I will give you a link to your own personal version of the dashboard, which will have those links at the top, like my version right here. Also, something I've been doing a little bit on the side, but I've been meaning to kind of more formally do, is I've also been trying to do some valuation commission work. So if you like the valuation work that I do, and you like the list of the companies I have on the dashboard, but there's a company that you would really like to see what my valuation would look like if I did it, or maybe in particular, you would really like to see what the valuation distribution might look like for said company of your choosing, you could choose to pay me to do valuation work for it. It is purely done on an academic basis, the results of which is not a recommendation to you in any such way. It's like you're coming to me and saying, I want to see what your value is for the company. There's no guarantees of how good the valuation is. It's up to you to then make your own investing decisions based off of whatever work I get you. But if you're willing to pay for my time and my effort, then I'm also willing to do commission valuation work as well. Which you'll also have a link on your own personal dashboard to access at any time the results of. So the commissions are a bit more expensive because you are paying for my time. I've done them for a kind of a range of prices over the last year, but about $50 is what it costs to pay for my time. So if anybody's interested in that, you can message me privately on the Discord or any way you would like. We can arrange something like that. So as you can see, trying to put forward a new range of offerings. We have our public dashboard, which is free to access for anybody that's willing to join the Discord. We have private versions of the dashboard, which I offer to anybody who wants them for $5 a month. And we also do valuation commission work for $50 a pop, at least starting. And for what it's worth, obviously, you can also not take a paid product, and if you wish to donate to the channel, the PayPal link or the Patreon link is below as well. So those are all of the ways in which you can choose to support the channel if you so desire. All right, enough shilling my products and whatnot. One thing I will kind of take some time to show you guys is the changes that we've done with the dashboard, because we have made some pretty significant upgrades to just kind of the stuff that we have here on the main page as well. And Jack, did Barrick switch its ticker to Ulta here? What do you mean? I got Barrick right here and Ulta right here. Yep, yeah, it might have been a lag or something. I don't know. It's possible that a formula could have gotten screwed up somewhere, but I'm not seeing it. So yeah, it might have been a lag or something. But maybe I'll take a closer look after the stream, see if there's an error there. But hey Jack, welcome to the stream. So here at the top, we have 50-day and 200-day moving averages and the ratio of the price to it. I plan to actually add some formatting stuff here. I kind of didn't quite get to that point here, but we also have daily and weekly RSIs with some color coding, RVOL, short interest, which I import short interest information as well as recent report information, as well as forward price to earnings information and total earnings yield information. All of that comes from stockanalysis.com. Not necessarily because I have some super preference for that website, but because I'm using website scraping methods to pull that information, and some websites are more friendly towards that than others. And so that's the one that I currently use because it seems to be the easiest one to scrape the data from. So sometimes I end up changing those sources here and there, but for the time being, that stuff all comes from stockanalysis.com. You can see right here, it starts to get more color coded as things are higher short interest. The reporting tab, as you can see, there's kind of different colors going on right here. I have it set up so that if stocks are going to be reporting within the next handful of days, they have this kind of orangish color. If they're going to be reporting tomorrow or they are reporting today, they actually flash red, and then the purple ones are ones that have recently reported. So you can kind of use this column as a way to see like what how much of new information has come out for those particular companies or is about to come out, so that it can kind of give you a hint about what's going on in terms of like the activity. Obviously, if you see like a big drop in a stock over here, and then you're like, oh, what's going on? And you see, oh, well, earnings came out today or yesterday, that might be a hint in the right direction as to what's going on there. Now, obviously we have trailing PE and forward PE, and then yield here, as I kind of already hinted to clarify, is a total shareholder yield. So it includes buybacks. It also includes dilution. So that's why you can see negative numbers here on the screen as well. So I prefer to think about total earnings yield, including dilution. It's because I think that more accurately reflects, the real sense of a yield. Dividends are only a small share of the cash flows that gets to pay out to shareholders these days, at least in the United States. Jack, wow, how have I never seen in mode? Balance sheet and cash flows look like a no-brainer. Really? You've been a viewer of my channel for this long and you haven't heard any of the talk about in mode? That's kind of funny. Because I mean, it's somewhat of a hotly debated stock within my little community, I would say. But hey, you're kind of always doing your own little thing, and more often just messaging me privately about random stuff. So I guess that's just kind of interesting, but it's almost kind of funny because I would almost assume that somebody who's kind of like a regular um, member of my community would just like know that one just down pat by this point, just because of how much it's been discussed. But yeah, no, I'll happily kind of give you the quick thesis on it. I will say it is a company that has its risks and it's been going through its difficulties, and I definitely think it's starting to turn the corner now. But anyway, it's a medical device manufacturer, specifically focused more on kind of like the discretionary aesthetic end of things. They have they have devices that use energy to essentially try to help with people with uh, the repulling in of skin after weight loss. So it's kind of like a luxury medical product, so to speak, much more tilted towards the upper end of incomes. It's also an Israeli company, so that's one thing I would point out, because obviously, what with all the drama in Israel over the last year, that has had a pretty major impact on the stock. And the stock itself went from a very, very high growth period into a much lower growth period, which I mean, if you haven't noticed, that's often a lot of the stocks that I like to look at is stocks that have slowed down in their growth, and therefore they end up like dropping 50, 75% because people assume that they're going from high growth to zero growth. And then I very often make, bets that, well, it's not going to be zero growth. It's just going to be moderate growth. And that's kind of what I would say is like the dynamic in terms of the forward potential for it. But they are an equipment manufacturer, so that means that they are more tilted onto like the capex cycle of things, which means while healthcare is generally a little bit more stable, there is a decent amount of volatility in terms of like when the medical offices would be purchasing their equipment. And so that's one partial reason for why there's been a large slowdown there. And then, like I was saying, it is also an Israeli company, so there's kind of all of that drama going on, as well as there has been a big, large back and forth in the kind of investment community surrounding the stock, because of its huge cash pile. And yeah, I noticed you're looking at the balance sheet, and the cash flows. Well, the cash flows are kind of its own thing, but the balance sheet, obviously, massive amount of cash and securities. Well, for the longest time, the company was basically refusing to do anything with that cash. They were kind of sitting on it, looking for opportunities for reinvestment. But because of their industry, while they are growing pretty decently within their little path of their industry, it's not exactly like some the type of industry where there's like a whole lot of opportunities where they can just go reinvest all that cash and just keep growing. It's like there it is kind of a limited growth space. Like there's a decent amount of growth potential, but only within like that a total certain amount of revenue streams. So they've kind of also looking for some acquisitions, which the management seems to be relatively strict in terms of what type of accretiveness that they're looking for their earnings. They really don't want to lower their gross margins and their EBIT margins too much relatively. They've commented on this several times. And then they were also refusing to do buybacks, even though the stock had been coming down very, very significantly. The management made some comments like early in the year, like literally, I think it was like January or February, that really, really upset a lot of the investment community because it kind of, he basically poo-pooed the idea of buybacks, arguing that giving a few examples within the medical aesthetic space of companies that had done buybacks and then had their stock crash much further after that. And a lot of people were saying that he didn't really understand the financial dynamics of how buybacks work, and were saying he didn't understand capital allocation. And you could definitely argue that it was not the wisest of comments per se. But since then, since the beginning of the year, he has kind of relaxed on that approach. And in fact, the CEO at the start of the year was both the CEO and the chairman of the board. He is a founder, by the way. So that's worth noting as well. But since then, he has been replaced as the chairman. He's now no longer both positions. They have one of the other executives now in the chairman role alongside him, which I think is a much better balance in terms of management. It means obviously that there's a little bit more give and take in terms of what the CEO does. And then they have approved buyback programs and executed on them. They actually repurchased approximately 10% of their stock within the last quarter or two. And then they are looking to do significantly more, but there is some limitations on what they can do with that in terms of Israeli law. They have to kind of get specific permission from Israeli authorities in order to bypass certain tax rules in regards to buybacks. So yeah, that's kind of a rundown of a lot of the stuff going on with it. Yeah, I mean, you could make that argument down 20% year to date. That means in a retrospective sense, that means he was right. But how would he have known that it was going to go down 20 more percent, right? Like that's looking backward and saying, oh, well, I guess he was right. It's like, well, I mean, that nobody has a crystal ball in terms of where the stock price is going to go. Stock price has moved where it's gone for a variety of reasons. I mean, I was never super negative on those comments. I understood like why people were upset with them, and I agree that they weren't like the most efficient financial answers he gave, but he also gave some, decent reasons for why he was being hesitant with it, because he was trying to put much more focus on growing either their core business or finding a solidly accretive acquisitions, which, I would much rather we do that than buybacks any day, as long as the acquisition in question or the reinvestment in question is going to get us very, very solid returns on capital. So, there was solid arguments both ways at the end of the day. Like I understood the analysts' points and I understood the management's points. And in my opinion, they were both pretty decent on that front. But either way, the point is he eventually gave up and started doing the buybacks, and we're starting to see that move in terms of the EPS now. And it also does seem like the fundamentals are turning a corner as well. In their first of all, their non-financial metrics, like their total install base, has continued to grow all year. That's one thing I've been pointing out to people that I know that have followed me into this investment. It's like, at the end of the day, financials do what they do. But if you look at the non-financial metrics that feed into the financials, like the KPIs, like the install base, those things can be more of a leading indicator of where the business is going at the end of the day. So it's like we're not seeing a lot of the profits show up in this year because of a lot of the slowdown. And I didn't mention it when I was commenting on the fact that it's part of the capex cycle. That means the interest rates have affected them pretty significantly as well. They largely lease out a lot of the equipment at relatively, they're not the lowest of interest rates that they are often charging to the offices. So it's one of these things where they've been heavily impacted by the interest rate environment that we're in. And I'm definitely looking to see them really start to sprout and grow again in 2025 and 2026. CVNA, I know I've looked at that one a little bit before. I can't really remember too much of my opinions about it, and I don't really feel too much like looking at it now. Um, but yeah, I know I've looked at that one before, but yeah, no, it's super super cheap. The question is how cheap does it really deserve to be? Because it probably didn't necessarily deserve the highest level of multiples that it had during its high growth phase. It was definitely significantly overpriced. But nonetheless, at some point or another, we'll probably get a multiple revision, especially once things cool down in the Middle East. That's definitely having a big impact on terms of the type of pricing metrics that it's getting right now. Mr. Beast, it's been a while. Good to see you, man. I'm doing pretty good. I hope you're doing good as well. CVNA is either Wall Street's greatest mispricing or accounting fraud and nothing in between. Public markets, 100 bagger in 2 years. Interesting. Yeah, I mean, if you think that there's even a chance that it's accounting fraud, then I'm not sure I want to look at it at all. Might as well just kind of forget about it. But nonetheless, as we're going to get to today, I've kind of tried to shift my entire focus in terms of how I look at stocks. I'm really like it's so what I've done throughout pretty much the majority of my investing career so far is either like gone to screening websites and screen through companies that way with valuation metrics and capital efficiency metrics and things like that to try to find things that I think are cheap, or in the kind of retail investor community, people will point out, oh, look at this stock, it's down 50%, or oh, look at this stock, it dropped 10% today, or oh, look at this stock, it has this, right? Like it's usually, I feel like it's usually a thing where I'm looking at things after they've come down, and obviously things come down for a reason, right? Stocks don't just drop out of nowhere. There's always some sort of negativity within it. And as I kind of had pointed out when I was talking about like that in terms of slowing down of growth, that's something I definitely think I've done a lot of, which is look at companies that have had major slowdowns in the fast level of growth that they had previously. And then my valuation thesis is usually based on the idea that they're no longer that they aren't going to have zero growth, but they might at least have like 5% growth. Or whereas, and I'm usually looking at a stock that is priced like it's going to have 0% growth or something like that. InMode is a perfect example of that. It's like it had very high levels of growth, and now it's priced like it's going to be going out of business in like 5 to 10 years. Whereas I think it could at least solidly have moderate growth. It's situations like that that I've often looked at, which I think has a certain benefit to it because it means you're looking at things that are cheap. And then kind of same thing when it goes, if you're just screening stocks, obviously you're looking at things that are cheap. But I'm really trying to shift my focus to going away from doing that. I have done a lot of thinking about, industries with themes and like economic patterns on that. I do like to do a lot of economic research on the side. But now my approach that I'm kind of trying to keep with is I'm trying to think more specifically about the long-term trends and themes that I want to focus on. Think about the industries that are going to do well within those themes, and then analyze metrics within those industries that I think are important to kind of like disaggregate different types of risks that I don't want to be overly exposed to, and then also try to do as much management research within those good companies. So it's like find good themes, find good industries within those good themes, find good assets, good companies within those industries, and then find good management within those good assets. And then, just put those companies on a watch list and wait for them to get to your price. I really, this is kind of what I mean by trying to shift my focus towards quality. It's not that I'm going to start overpaying for assets and just hope that they're going to grow into the valuation, as people often like to say. I don't think things grow into valuation at all. In fact, I think that phrase is a complete misnomer. At the end of the day, value is value. Growth is part of value. Something is either undervalued or it's overvalued. But at the end of the day, I think you can accept a smaller margin of safety on that undervalued level if you have a lot of these other factors working in your favor. The idea of a margin of safety is often to protect you against your own misestimation in the fundamentals, and also to protect you against obviously the crazy volatility of markets themselves. So I'm just trying to shift my focus towards all the other aspects first, and then really kind of make the valuation be the last piece of the puzzle that falls into place. It's not something that like we're just ignoring valuation. I think, like I said, the person that was talking to me in the chat when I was talking about this a couple weeks ago kind of misunderstood that, because he seemed to think that I was saying that, oh, I just want to focus on quality. It's like, no, 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 no. Price and value is important. I just think that it really ought to be, basically the last piece of the puzzle that falls into place. Like, you have already identified all of the other positive things that you like about the company, and then now it's just suddenly gotten cheap, and then you hop into it, rather than just things just come to my attention because they're cheap, because people show me and they're like, oh, hey, look at this thing, it's cheap, you should look into this, Midas. And then maybe I find that it is cheap or not, but maybe I don't really fully discover all of the reasons why it's cheap, or maybe I discover them, but maybe it's after I've already started a position, right? So the point is, I think I've kind of put the cart before the horse, so to speak, when it comes to thinking about the cheapness of a company, and I'm really trying to completely reverse my investment approach, or at least like I said, my research approach, not necessarily my investment approach, because valuation still at the end of the day is a prerequisite. So getting some of those, kind of follow up on what you were saying about C of N A. I mean, 50 billion accounting fraud is pretty interesting. No, there was a short report on them. Oh, well, maybe I'll go read the short report at least, just for curiosity's sake. But I mean, I just meant like in terms of whether or not I want to invest in it or not. I don't know. Like I said, I'm trying to not think of things in that direction. But maybe I'll go read the short report just out of curiosity. Mr. Beast, you're buying Mastercraft. Yeah, as I have said several times before, I've been buying Mastercraft, and that is one of the companies I have been nibbling on a little bit here and there, in the last few weeks. But very just small nibbles. I'm buying it because it is, in my opinion, one of the more undervalued of companies on my dashboard. So to me, it just screams like a solid value. But Mastercraft doesn't really fit into, particularly well into a lot of the themes I'm trying to focus on. It's not necessarily like contrary to those themes, but as far as I'm concerned, it's just a cheap stock. It doesn't necessarily have a lot of great tailwinds to it. And that's kind of the thing that what I mean when I'm saying I'm kind of trying to focus on a lot of these themes aspects of it, is I'm really trying to make sure I have good tailwinds. Because at the end of the day, it's like there's price and value, and you can buy things that are valued all day, but if you don't have some sort of way or catalyst for them to reconverge, for value and price to come back together, then you're not necessarily going to get paid. You can get paid with a stock that stays perpetually cheap, but you can only get paid if management is paying you, if they're paying you dividends, if they're paying you buybacks, although buybacks themselves still technically rely on some valuation movement. It relies on price movement accretive to the change in EPS. It doesn't necessarily require revisions in their, or a re-rating of their multiple. But a stock, you could have a company, you could have management continue to buy stock, and it goes from a 5 PE down to a 4 PE to a 3 PE to a 2 PE to a 1 PE while they're buying back stock, right? So just because a company's buying back stock doesn't necessarily mean that your price moves upward. It just means that you now own more and more of the company. Cash dividends technically are the only direct way that a company literally pays you cash, or spin-offs technically. That's another method as well. But buybacks are usually a solid method of getting cash flow returned to you, because you generally assume that if a stock's already trading at a super low multiple, like a 5, 4, or 3, well, it probably can't get too much more cheaper, right? Knock on wood, obviously, because some companies get extraordinarily cheap. Mr. Beast, you've seen reducing of InMode because of war. Are you asking if I've been reducing InMode because of the war? Because I definitely have not. Or are you talking about just like how much it's been coming down over time? Or are you saying that you have reduced InMode because of the war? What I'm not sure what you meant by that. And Jack, basically combining the technicals with the fundamentals, which is really hard to do. Mastercraft revenue falling off a cliff, what makes me skeptical. Costs didn't scale, so income just disappeared. Well, they are a super discretionary product. So, and the super discretionary, high expense product is definitely going to be massively impacted both by inflation, slowdowns in the economy, and interest rates. Not to mention that they had a huge run up prior to that, so there was definitely some like
oversaturation relative to their overall customer base, that probably essentially borrowing from the future in terms of future customers for themselves. And then part of their revenue coming off as well, it's worth noting, is that they've sold off a segment here recently. So it's a little bit of a mixed bag in terms of Mastercraft and their revenue. But I mean, hey, I encourage you to maybe take a look at maybe your own DCF inputs on that one as well, because I think it's hard not to find Mastercraft pretty cheap, no matter how you look at it. That's part of the reason I started a position. But as I was just saying, it doesn't really fit super well into some of the themes. So it was an example of me just buying things that just looked super cheap. And I did do some research in terms of like thinking about how good I thought its brand was relative to other brands within the space. And so I did think that I found it to be a relatively decent brand. But nonetheless, that's not really a solid tailwind either. But we'll see. It's worth noting that yeah, its earnings is coming up, and Malibu, one of their competitors, reported pretty solid beats yesterday, I believe it was, as well as I was looking at Garmin's earnings. Garmin obviously isn't a, a, a naval vessel company, but they do have a pretty significant marine segment, and the marine segment is doing really well as well. So I'm somewhat optimistic for their upcoming earnings, but we'll see about that. If it's cyclical, what's their guidance look like? I actually can't remember off the top of my head exactly what their current guidance looks like, but I mean, you can go to their investor relations page and find out. But yeah, super cyclical. They have pretty significant growth opportunity in front of them. They are a very small player within obviously not a very large space, but a space that's much larger than them, and they have a decent amount of opportunities within that. But as I said, it's not a company that I'm overly trying to focus too much of my capital on, because I'm really trying to shift my attention away. It's like I haven't gotten rid of it because I think it's super cheap, so we're just holding on to it. As you can see right here, it's 2.2% of my portfolio, so it's a not a huge position. And uh, the goal with all of the new research is to really start concentrating my portfolio towards these higher quality companies that have a lot of tailwinds behind them. So over time, positions like Mastercraft, and even positions like InMode, because I would say a lot of that thinking applies to InMode as well. InMode works within some of the themes that I think are relevant, but not necessarily the strongest of the themes, or the most confident of them. Like there is pretty significant economic trends of people moving towards higher levels of aesthetics focused medicine, discretionary healthcare spending, older generations trying to recapture their youth and stay within a healthy lifestyle. Not to mention, there's also a lot of talk about how the GLP-1 revolution could have an effect for them if people are going to be losing weight, or at least avoiding getting as heavy as before. Then that is potentially some opportunity for InMode as well. So yeah, those two have some similarities in terms of them being, I would say, kind of like discretionary, somewhat cyclical products. Also somewhat focused towards the more luxury or upper income class level. But obviously they're very different as well, in a lot of different ways. Mr. Beast, reducive earnings. I meant because Lebanon is near to in mode. Yeah. In fact, in their recent call only a couple days ago, they actually commented on this. They are currently looking at some opportunities to maybe expand their production facilities outside of Israel in the near future. So far it's just talk, so we'll have to see what type of results we get out of that. But they did actually give some specific comments on that. Apparently, despite the fact that they are relatively closer to the northern border. All of their employees have basically just still been coming to work every day. It's basically has still had relatively no impact on their business. But obviously that could change if things were to get a little bit spicier in that area. Although I will say, I mean, I've been kind of optimistic throughout the whole conflict, but I remain optimistic. So nonetheless, I'm not necessarily expecting the conflict to end tomorrow, but I really don't personally feel like Israel actually has that much real danger to them. A lot of people have different opinions on that conflict, so we don't need to get too deep into all of that. But at the end of the day, I think things will start to relax here hopefully somewhat soonish. There will probably be maybe a few more little back and forths between Israel and Iran before it all gets over, but that seems to just be the way countries negotiate with each other in the Middle East, as uh, as crazy as that is to some of us in the West. But uh, so anyway, let's get into some of the discussion about the research. So talking about themes, here I have kind of my list of themes that I'm focusing on. This is just kind of like a very broad list. This isn't really like all the things I'm really like. If it's on this list, it doesn't mean that I'm like going out to go invest in something related to it. It's like these are just a kind of a broad list of ideas, just kind of spitballing some stuff out here. I do have it kind of bifurcated into two halves of higher confidence and visibility versus lower confidence and visibility. Um, Confidence and visibility means like how much do I think the trend is happening right now, and how much confidence do I have in it persisting, right? So it's like how much of it has it already revealed itself as something that's going to happen, or is it something that's more like in the future going to happen, versus, and then confidence is, like how confident am I that this is a persistent trend. So I kind of like listed it into the ones I'm more confident in, and then things that I'm maybe not as confident in, for varying reasons. And people are, of course, free to disagree with me on a lot of different ways. This is just kind of me thinking about some stuff. And then I have listed industries or assets that are potentially going to be winners, due to those themes. Obviously, it's not necessarily a super broad based kind of thing. It might be very select people within these industries or these asset groups, but just kind of ideas of ways that you might be able to capture on some of these themes. Um, I did also kind of list it up here as themes, memes, and ideas. I kind of mean that somewhat seriously as three different things. A theme, in my opinion, is a trend that exists that is ongoing and persisting right now. A meme is something that people think is a trend, but is not actually a trend. But that itself could create an opportunity, right? Because if people are doing the same thing I'm doing, and making investment decisions based on what they perceive to be a theme, and then it's not actually something that is a real trend, that means it's only temporary, their actions, and then at some point there will be a reversal. So that means whatever they're doing, you can move contrary to their own action, and that can create an opportunity for you. An example of that would be, in my opinion, like for a lot of the way larger funds have allocated their capital over like the last several years in regards to ESG, as well as global warming. A lot of major funds had been discarding basically all of oil and gas, right? And that created a great opportunity for people to capture on the huge moves in oil and gas stocks in the last few years, if you had bought them at the right time. So that would have been a good example of like someone capturing on a meme rather than on a theme specifically. And then ideas is more like something that would become a theme in the future, but maybe isn't quite there yet. So obviously, once we've definitely talked about the boomer retirement wave here on the channel. I already have investments in place that kind of capture on that. Power grid weakness, as well as the need for it to expand. There's also, I think, kind of in line with the boomer retirement theme, there's also millennial families. The millennial generation here in the United States was a little bit slow to begin the family creation process on average, if you kind of look at the broader statistics, but that they are starting to build families now. If there really is a wave of millennials essentially starting to have kids, starting to buy homes, starting to accumulate capital. So there's going to be industries that are going to be able to benefit from that in the same way that there's industries that benefit from the boomers moving to retirement. And then kind of in line with both of those together, there's going to be the generational wealth transfer as the boomers themselves begin to, let's say, expire. So there's going to be industries that benefit from that. Fiscal crisis, monetary debasement. The federal government spends like crazy and is just going to keep diluting our money. Housing shortages, immigration, onshoring, e-commerce, the electrification of the grid, China depopulation, car maintenance, EV picks and shovels, AI.com parallel, oil services capacity. Kind of already mentioned that a little bit. Trade labor availability. Anybody could ask any questions what I mean by these if they don't necessarily know what I mean by that. But I don't necessarily want to go into each of these all in super high detail. I'm just kind of showing you how I'm thinking about things now. It's like I'm trying to start at a very high level, thinking about economics and economic data, and then identifying themes within that space, and then moving down to focus on industries that will then be able to benefit the most from those themes. And then once I've kind of identified some industries I want to focus on, then going to look at as many of the companies within that space as possible to think about which are the best companies themselves. Um, the ones that are red here, the red text, are the ones that repeat themselves a lot. So you'll notice, like, for example, utilities appears in lots of places here. Housing appears in lots of places here. Electrical equipment appears in lots of places here. Gold appears in lots of places here. Or really, I think I marked it red if it just appeared like at least twice. I think was the rule of thumb I used, if I remember correctly. So you can see is like there are some industries that can capture on multiple themes, which I think makes them even more robust of a potential. Here, give me a second. So obviously, if we can choose an industry that is potentially going to be able to capture on multiple themes, that only compounds our potential success in having that tailwind deliver our valuation or deliver our price to valuation. Like I said, all of this is about trying to close the gap between price and valuation, getting into investments that have the best potential for the price to value gap to close instead of just sitting for very, very long periods of time in stocks that potentially have a great value to them, but maybe you're going to have to wait a decade for that to show up. Obviously, that's fine under certain circumstances, but I've been in investments for several years before they paid off before. But at the end of the day, I think that you can do a bit better if you start from this kind of higher level and try to get as many tailwinds behind you as possible. So that's kind of what we're trying to do is we're trying to do that. The focus, the ones I'm really trying to focus on a lot, housing, electrical equipment, um, building and construction, and pretty much everything related to building products, utilities, household durables, as well as computers, durables as well. Defense is another one that I think is has very strong confidence to it. Business and consumer services, especially like employment services, as well as auto and auto parts. Those are definitely spaces that I think have a lot of really, really good opportunities to them. Oh, and I didn't actually even throw it on this list as well, but miners, mining, metals mining, especially things that I'm trying to focus on. So the things we're going to be looking at here today, obviously in the thumbnail, I kind of showed a little ranking list. We're not actually going to be doing an SAB, CDF tier list today. That's not actually what we're going to be doing. I've kind of already used my own kind of methodology for ranking them, but obviously people love their tier list, so I thought that would be a good way to show what we're talking about. But we're going to talk a little bit about miners and REITs. Now, I did these two groups first really because I knew that they would be easy to be able to do a pretty broad level kind of qualitative analysis like this on much quicker. So like I want to be able to do some analysis on as many of these kind of spaces as possible, but I knew that this would be one that would be easy to do, partially because of things I already knew about those industries. There's a lot of more uniformity in how certain metrics are reported, and also in just like how a lot of the companies within that space behave, which makes it easier to compare them within each other. Like for example, if I'm really interested in a lot of industrials, which I am, you'll notice industrials is the sector a decent amount of these kind of industries do fall into. But industrials can mean a lot of things. Industrials could mean machinery. Industrials could mean electrical equipment. Industrials could also mean employment services. So it's like, it can be very broad what that means. And so it becomes very apples and oranges to try to compare them, which means you can't really compare them on the sector level. You then kind of really have to drop down to an industry or even a sub industry level to really start comparing companies to each other, which really creates a lot more work if you're trying to do that. So I started with mines as well as REITs because those ones are a little bit easier to compare, even with a lot of differences within them. So, because like for example, with miners, obviously there's different types of metals. So like a gold mine is not the same as a copper mine, is not the same as an iron mine. But nonetheless, they do have a lot of similarities in terms of specific kinds of things that they report, which would make it easier for me to kind of compare. So like here, first of all, on the left-hand side, the color here is an indication of what type of metal they are. Gold obviously is kind of the yellowish color. The gray is silver. The purple is the companies that are basically a perfect split between gold and silver. I just kind of chose a very different color for that one. This light red is the largely copper players, and then these like darker gray ones are kind of more base metals. Or there's also a coal player in there, which is partially because I wanted to throw AMR in here because people were asking me some questions specifically about that. But base metals and coal are just kind of like an other category, so to speak. But you'll notice there's a lot more gold miners on this list than others, and that's because that's frankly the space I'm most interested in terms of metal mining. But I am very interested in copper, and I am somewhat interested in silver, and I am somewhat interested in other industrial metals as well. So now the when narrowing in on quote unquote quality assets within these space, I'm going to be using lots of subjective decisions in terms of what I'm going to focus on. The things that I'm choosing to focus on are the things that I think bring risk to the table that matter to me. So somebody else that wanted to do a similar type of analysis might say that they want to focus on other things. That's fine. And they might have a totally different way of assessing it. So one example of kind of what I mean is like one thing I chose to do here is I took a look at where they have all of the reserves of their assets. See, like mines, it's not so much about where they sell their products to. A lot of people like to pay attention to like, oh, this company sells 20% of the revenues comes from China, and maybe you might consider that a risk if you're worried about China or something, right? Like that's something you hear in investing circles all the time. Well, with mines, it doesn't really matter who you sell your product to. At the end of the day, commodities are sold into a global market, and so if one country stops buying your product, you can generally sell it to another country just fine, no issue. The only thing that really matters when it comes to mines is the aggregate global supply and demand. So if there's one country where that has a disproportionate effect on that aggregate demand, that can matter to a certain extent, and that does matter, for example, with China in terms of like their demand for coal or industrial metals, that they do have a very significant impact on that. But at the end of the day, if China's demand hasn't shifted, but they stop buying the metal or the coal or whatever from this specific company, that doesn't really matter to this company because they can just sell it to somebody else as long as the aggregate demand levels didn't change. Because if the aggregate demand levels didn't change, then the price didn't change. So that's just the nature of commodity markets in general, is that somebody is always willing to buy your commodity, sort of. Like I said, there's a lot of funniness there because supply and demand still matters. It just matters much more on a global level than it matters on kind of like an individual microeconomic level. That's why, to me, the real risk of a mine is not who they sell it to, it's where they do the mining. So that's what we have here is kind of a listing of percentages of where people hold their assets. Now, I chose to group them into different categories based off of the risk levels that matter to me off of those domiciles. So to me, the United States and Canada are basically the safest places to hold your mine. That's partially because I'm a United States citizen. So if you're not a United States citizen, you might have, maybe you don't think of the United States as a great place to have a mine. But to me, I consider the United States to be, you know, a perfectly safe place to have a mine. I literally have no geographic or political concerns about having a mine here. Now there is, you know, reasons why you might not want to have a mine here because, you know, there's like labor costs are higher in the United States, there's environmental costs and things like that. So there's, you know, there's complications to having your mines here, but I'm talking about like the risks that there's going to be like a big political turnover, there's going to be legal changes, there's going to be some major conflict between one country and another that's going to make it so that they don't want to import or export to another, like things like that, like more like the way the politics of the domicile itself is going to come into play there. So to me, I don't worry about if a mine is in the U.S. or Canada. And then there's kind of like a second tier where I would say I'm pretty fine with assets that are held in the UK, Australia, as well as most of Western Europe. So it's kind of like my B tier, so to speak, for this particular metric. And then Mexico, I kind of have in the next category by itself a little bit. I kind of separated Mexico out separately because I kind of have this third category where a lot of things are, but I decided that Mexico is a little bit better, partially because of the influence the United States has on Mexico, is one of the reasons why they kind of get a slightly better rating than a lot of these other categories. Because here I have East Asia, as well as Central and South America, as well as uh, the uh, the rest of Eastern Europe as well. East Asia minus China, plus Eastern Europe, plus Central and South America. And then after that, I have the Middle East. And then after that, I have Africa, China, and Russia. So you can see like Africa, China, and Russia are like my bad space, so to speak. And again, everyone's free to disagree. They can have your own metrics. Frankly, it's like it's fine if you don't agree with the ratings I give the companies. I'm really just kind of trying to show you my thought process, and maybe you'll find that you can do something similar using your own methodology. So I just use a very simple scoring system where 1 point for Africa, China, Russia, 2 points for Middle East, 3 points, 4 points, 5 points, 6 points. So you could get up to 6 points for this metric, or you can get down to 1 point. And then we took essentially a weighted average based off the percentages of where they hold those assets, and that gets me the score here in this column. And so that's kind of the idea of what we do for all these scores. And then I'm essentially scoring these different metrics and then counting up how many points that each company gets in terms of score for all the different risk measures that I use. So that's where they domicile their reserves, so where they actually have their mines and where their assets actually are. And you can see here the kind of the point distribution I have. And then here at the top, I have the median value for that. So the median value across all the mines that I scored here, which was, let's see, how many did I do for the mines? 37. I have 37 companies that I went through and did this for, which by the way took a while because I did have to go through 37 10Ks and 37 presentations to find all of this information. And I discarded a few companies because some of them weren't giving me the information that I wanted as well. So technically I went through more than 37 to get the 37 you see here. You can see there's a few companies in here that have a perfect 6 score because they have 100% of their assets in the United States or Canada. And then there's other companies here that have 71% of their assets in Africa, China, Russia, probably Africa if I had to guess, because there is a decent amount of gold in Africa. So that's going to be probably one of the reasons for that. So we have, scores that can vary as far as from like a 6 to like a 1 something, but 4.5 was the median score here. And anything marked green is anything that's median or up. So that's basically saying that these are better than typical in terms of where they keep their assets in this particular metric. Now moving on, the next metric that I chose to care about for mines is their all-in sustaining costs, which known as AISC, which is a metric you hear in the mining industry quite a lot. Now, obviously, that's going to be different depending on what type of asset they have. So I had to kind of keep track of this metric across a few different spaces. Now, I really only focused on it I really only wanted to focus on that largely for gold, silver, and copper. But like I said, I did include a few other things in this category, so I kind of had to like mix and match a little bit in terms of that. And so we also were paying attention to see, okay, which companies have lower all-in sustaining costs relative to typical. So the median value I got for the companies I looked at for gold was 1289 for an all-in sustaining cost per ounce. And so I flagged a point for each company that did better than typical in terms of their all-in sustaining costs for gold there. And like I said, I did likewise for silver and copper. I didn't really care too much about that metric, like I said, for the base metals. So in some ways, they kind of got a little bit of punished for being in a different category all on their own for that. And I tried to do both gold and silver and copper for companies that do mining of both or all three of those metals, because there are plenty of examples of companies that do that. And then the third and final metric that I used for mines was how many years of reserves do they have left? Because to me, this is something I've kind of like come around to over the last like year or two. But I think you can directly come to a direct, much more logical choice of a terminal multiple for a mining company based off of how many years of reserves it's going to have left after the 10-year projection period in a DCF. You can use a discounting factor to come up with, in my opinion, an appropriate terminal multiple for a mining company based off of how many years of assets you have left. The reason why I think this works well for a mining company is because the typical company, when you do a DCF for, you're assuming that they're going to exist forever. You're essentially assuming that those cash flows go into perpetuity, especially after you reach the end of your projection period and the growth enters the stable growth period, and you're using the stable growth model. But with a mine, it's much more like a growing annuity or even a static annuity, which means that it's not going on forever. It really has a definitive life to it, and that really is the life of the mine, right? So like there is actually much more of a sustainable limit, which I think explains why mining companies trade at the low multiples they do, is because, well, I mean, that's one of the reasons, because there's other reasons as well. Reinvestment, for example. But yeah, high levels of reinvestment, but also a limited amount of life, which means a limited amount of terminal growth. In fact, potentially likely negative terminal growth, because they only have so many years after 10 years of life, depending on the company, obviously, depending on the company, because some companies have many years of assets and other ones have relatively small amounts. So the point is, I chose to calculate how many years that they would have on the both for gold, silver, and copper, or whatever metal they have. Like I said, I tried to kind of read as well as I could between the lines on that. And then I took a weighted average of those years if they had multiple metals, based off of what percentage of their business is within that metal itself. So this column here, we essentially have like a weighted average years of reserves life right here. Now, one other thing to keep in mind, since I'm kind of already talking about this concept, I might as well include it too. Is that when you're talking about reserves of a mine, technically speaking, they have more than the reserves, because there's a difference between what they call reserves and resources for a mining company. So your reserves are essentially the amount of whatever. Let's say it's a gold mine. The reserves is how much gold that is expected to be under the ground, and therefore how many years of production you have at the current economic conditions. And then there's different levels of reserves and resources based off of how those things change. So when they calculate how many reserves they have, it's assuming it at a certain price level. Because at the end of the day, if gold were to go up to a certain enough level, it would make it more profitable to essentially try to get even more gold out of the ground. There is more gold in the ground than it is profitable to actually pull out, which means people aren't going to pull it out, right? And so at the end of the day, there's no point counting gold that's believed to be there if you're not going to be pulling it out of the ground. So that's kind of like the difference between reserves and resources. And so all these numbers are based off of the reserves, and technically it treats the resources as though they're essentially not existing. So while I'm saying that you should expect kind of a low terminal multiple on mining companies based off of the reserve levels you have, technically speaking, that would be like the pure reserve valuation. But then if you were to really try to be, I guess, much more thorough about it, you would probably want to add some sort of like optionality value on top of that for the resources as well. It's like I wouldn't necessarily give it a direct increase in value of it, but that resource and whether or not the prices will go up to a high enough level to make it economically feasible to pull them out of the ground, it's sort of like a call option on those additional reserves. It's like the ability to convert resources to reserves is essentially like a call option of sorts for companies that have them. So there is kind of like a pure reserve based valuation, but then technically speaking, there's like a little bit of an optionality value on top of that. So just kind of wanted to clarify that too, because a lot of people don't necessarily understand um, those kind of finer details about mining companies. That makes it so that they could be more profitable than they seem, depending on what you assume or expect about the future. So either way, here on this column here, we have then calculated together how many points each of these companies gets based off of those three factors. That's literally just three factors that I chose to care about. Those were the things that I thought were essentially the risks that I wanted to pay attention to when it comes to paying to mines. It's like I want to know where are their resources, where is the assets themselves, because that to me exhibits a significant amount of risk. And then what is the all-in sustaining cost for those resources, because that tells you essentially how far the commodity price could crater while they can essentially maintain a decent level of profitability, or at least sustainable profitability, so they won't go bankrupt. And then also how many years of reserves, because then that kind of tells you essentially how many cash flows you're going to be able to get out of the company itself. So with that in mind, then here the companies are already listed in order from 3 to 2 to 1, which, like I said, it's only 3 points. So there are some companies that get 0 in there as well. So yeah, anywhere from 0 to 3 points, and then that's kind of the listing of the scale right here. And then within that, so you can see like the threes are all gold mines as it shows right here. And I only looked at 37 companies, so obviously, like, to me that's a reasonable sample size. But at the same time, you could easily double that, triple that, quadruple that, and get more results out of it. But like I said, it required some serious manual looking, to get this together. So, I only have so much time on my hands. I can only do so much. I stopped at 37. That's just kind of what I chose to do. But it's worth noting that, yeah, so the goal here then is to go deeper. Right now it looks to me like these, what is that, five gold mining companies are potentially have some really good assets to them, but I'm going to go look deeper. The next step at this would probably be to go look at management. I would uh, I would go and look at the management teams and the directors for all of these. I'd go look at what kind of insider ownership they have. I look to see if we have some founders in there, maybe see what type of maybe what their previous experience was. I find within the mining space, there's it's often easier. I mean, that assumes that they actually do have good experience. But the point is, if your management has had some really good successes in the past, I find that in the mining industry, in their presentations or on their website, they will often boast about this, much more so than other industries. Like other industries, like if their management teams have like decent experience in the past, they're often very vague about like what the actual successes of their experiences. They'll be like, oh yeah, they worked for this company for this many years, and like that's all they'll say. Although they'll be like, oh, they graduated from this college, or oh, they're a member of this board, and that's kind of all they say. But they don't really give you like super specifics in terms of like the experience, at least not directly on their websites or in their presentations. There are exceptions to this, obviously, but I mean, just in general, in most industries, it seems to me like they don't really do a lot to like really show you what their management teams have done. Whereas in the mining space, I found several of these presentations would have like a dedicated slide or two where it would tell you this management member worked at this company and they worked on this project and they helped discover this many resources and they worked to do this type of acquisition and they created this much shareholder value. Like they're weirdly specific about the successes of their management team, assuming their management team has successes. Like I said, not every company does this, but it's I found it more often in these presentations in this industry than I find that kind of information in other industries. And it's like, which is great, right? Because that means it gives you something a little bit more tangible to really kind of grasp onto in terms of thinking about like, is this a good management team? Are they going to be able to deliver value for me? So that will be my next step, is to go through these five companies, try to carefully analyze the management, take some notes on it, and then try to decide which management teams I like the most. And then I'm not going to just stop at those five. We're gonna, we'll look at the twos as well. It's worth noting that the median value for the point was a two, so I'll probably look at the twos and up. That gets us a much larger list. Not to mention putting the twos in there gets us some of those other metals as well. We get some silver players, a couple copper players, and then those base metal players managed to make it into the twos as well. So that's 20 companies right there. If I was to look at all of that, that'd be 20 companies that I could go diving into, look at their management teams, and then maybe try to narrow in on like my favorite, I don't know, five or something. I could maybe like find my favorite five management teams on out of that 20. And then maybe once I've got that five, I could then go and do some basic DCFs on that five, right? And so you see how what I mean now, right? Like we started at some economic data that led us to some ideas and about some tailwinds, some themes that could potentially be profitable over like the next decade or so. And then we narrowed in on industries that would capture on those themes. And then we found what we think are pretty low risk, solid, good quality assets within that space, at least from a high level. Like, we're doing some very, very high level analysis here, there. Maybe as I dive into those companies, I'll decide that their assets aren't that great and I can discard one if I want to. We don't have to hold to these metrics like it's some sort of gospel or anything. It's just some quick and dirty screening, but using mostly non-financial metrics to do the screening. See, that's kind of what we're doing here. It's like, this is still screening. It's like, this isn't really that different than a lot of the screen presses I've done in the past. But the point is you'll see that there's almost nothing related to an income statement or a balance sheet around here. Like the vast majority of this is completely non-financial. The closest thing we get to financial here is the all-in sustaining costs, which is a non-GAAP measure, right? It's just a very common non-GAAP measure used in the mining industry. But that's the closest we get to financials in terms of this analysis here. So I think that's good. I think that helps us to essentially kind of like separate the two so that we're not like saying, oh, this is a good company because it's a good value, because it's got a high ROIC, and that means it's high quality. Because like, I've often heard, and I've been guilty of this too. I've used this metric too. Is like people often use like a metric like return on invested capital as like a proxy for quality. High ROIC is not high quality. High ROIC comes from high quality, right? Like that's a big difference there. high ROIC is the result you get if you are high quality. It's not the thing that makes you high quality, right? So it's like by looking at something with high ROIC, you're putting the cart before the horse. And that might work. You might be able to find some high quality names that way, but I don't think everything that has a high ROIC is high quality, because sometimes companies have high ROIC very briefly for a short period of time, like for because of they're at some part of their cycle or something like that. You kind of really need to look deeper than just like the one metric there. So that's kind of what I mean by starting at at the qualitative stuff and then working our way towards the valuation. It's like we've narrowed in on 20 companies. I want to maybe look closer at their management teams. And then, like I said, maybe I'll pick like my 5 favorite management teams out of the group or something like that. And then maybe once I've got that 5, then we'll go do some basic DCFs there. And then maybe none of them will be a good value. So maybe I'll have to look at more than 5. I don't know. Or maybe there won't be really good values at all. So maybe I'll just pick the 3 that I thought had the best assets and the best management teams that aren't super far from value, and then I'll just put it on my watch list and then wait, right? So that's kind of the idea here, is I want to make the valuation part of this process essentially the last step. It's the thing that we're looking at last after we've already decided what the good quality companies in the good industries that we want to look at are. And then no, we're not just going to buy something when it's overvalued anyway. We're just going to maybe not buy it today and instead maybe wait for it to come to our price. So that's kind of that's the mining space. That's the analysis I've done on the mining space here. Feel free to zoom in, screenshot, do whatever you want. You, like I said, you can do your own research on these other companies. You can take my qualitative scoring method here for granted, or maybe you can disagree with it and you can do your own methodology to it. But the point is that's kind of what I chose to do with mining space. And there's plenty of other mining companies too. I have lots of other tickets listed here that I didn't quite get to. So there's lots of mines to look at. I just looked at the first 37 that came to mind. And frankly, I started at the highest market caps and worked down. That's basically what I did, by the way. I just kept it simple in terms of like how I picked the stuff I was looking at. I just started with the biggest mines and worked my way down, and that's kind of how we ended up with. And like I said, it's reordered now in terms of like the actual quality measure that I have here, but still. So let's move on to REITs, because I did basically the same process with REITs, though very differently, because REITs are a totally different sector with totally different qualitative things and risk measures to them. And frankly, I actually used many more measures here because it was easier for me to kind of come up with several that I thought were useful. And the thing with miners, one moment back to the mining ones, is that because another thing is that initially I thought, oh, well, I should probably keep gold and silver and copper and the base metals separate because those are very different types of mines. So they're going to have very different metrics. And I was initially what I told myself. I was like, oh, I should probably actually do separate lists for each type of metal. But what I found is that the actual median differences weren't that different between those categories. So at the end of the day, it seemed to me better to just kind of combine them all together, because then the sample size was larger and I could just work from there. And then, I mean, as I already showed you, is like once we went down to the median and up score, we still ended up with a decent handful of those other metals categories in here. So at the end of the day, I found that it didn't really matter too much to keep the category separated for miners. But with REITs, I was a little bit more concerned about that, because REITs can definitely vary a little bit more depending on the type of assets there are. For example, like when it comes to commercial real estate, or real estate in general, is kind of bucketed into these major categories. Specifically, commercial real estate is bucketed and usually into multifamily, which generally refers to apartments, industrial, retail, office, and then there's often a specialty category that's thrown in there as well to include things like hospitality, self-storage is usually thrown in there, medical facilities is usually thrown in there. And then multifamily, I chose to label as housing because I was also trying to look at a couple mortgage REITs in this list as well. So I just kind of like threw the residential in with the multifamily there. But nonetheless, what about the Bitcoin metal? I don't know. I'm not sure what the all-in sustaining cost for Bitcoin is, I guess. Might have to figure that one out. liking the miners right now, no Diddy. Yeah, well, I mean, there. I kind of started by saying that I did the mines and the REITs partially because they have more consistent metrics that to compare against each other, which is true. But I also chose these categories out of those themes first, partially because of um, a little bit more of a higher priority sense in my mind, and that has to do with timing. Um, I mean, I don't know if you've looked at a gold chart anytime recently, but all of the stuff that I've been saying for like 3 to 4 to 5 years, depending on, you know, I wasn't on YouTube 5 years ago, but if you knew me personally, I was talking about it 5 years ago. It's like basically everything I've been saying about gold has been coming true very, very quickly. And so it's kind of putting a little bit pressure on my mind to really start to to take a little bit of a closer look at some more gold mines, and then also has to do with the fact that of the position of the current gold mines in my portfolio, because I have had gold miners in my portfolio for basically the whole time I've been an investor. But like I hold Barrick currently, and I hold Silver Corp, and I had New Gold up until a handful of months ago, and then I sold out of New Gold, and I almost regretted it very quickly after I did it. And part of the reason I regretted it is because that was around the time I was starting to think about this process, and New Gold, out of those three of that I had owned up until just like a handful of months ago, they literally have all of their assets in the United States and Canada. So they were a quote low risk mining asset that I then discarded because it had reached a decent amount of valuation. And then also, you know, I have changed my valuation template around, so that kind of allows me to fine tune some of the assumptions that went into it. So frankly, I do think that New Gold is a little bit has a little bit of a better value to it than I was giving it credit when I sold it to. And then also on top of that, uh, New Gold has come down a little bit from those peak levels. So part of me is actually tempted to maybe even come back into New Gold a little bit. But anyway, I digress from that point. The point is, I was like, well, let's not just hop straight back into New Gold willy nilly after you got out of it. Let's actually take a look. Let's see what mining assets we think are high quality, and then we'll move from there. So that kind of led to this research process. It's worth noting, New Gold is on the list. Where were they? I thought they were at two. Yeah. Oh no, they were one. My bad. They were one. So yeah, they ended up having really good assets. Like I said, 100% in the United States and Canada, but they actually have a really low resource life, and they like just barely missed the cutoff on the all-in sustaining cost metric, like 1290 versus 1289. Which, hey, you have to make a cutoff somewhere. You can't really just make exceptions for one company and not make exceptions for others. So whatever. They ended up being a score of one. So the point is while I was kind of regretting hopping out of them a handful of months ago, yeah, no, it is what it is, you know. But the point is, as I was saying about kind of like I do have a little, I do feel sort of rushed to work on miners right now because part of me wants to trade out of my Barrick position to maybe a better gold mining position if I could, or maybe and trade out of maybe my silver core position maybe for a better gold position. I would really like to keep gold mine exposure in my portfolio, but I would maybe prefer to find some better opportunities within the space if I could. So it's one of the reasons I'm focusing on miners right now, and then industrial metals too. Like I'm talking a lot about gold, but I am pretty bullish on copper over the next 5 to 10 years, and I'm moderately bullish on silver and steel as well. And then steel is relevant with iron, obviously. And I'm moderately bullish on aluminum as well. So like I'm pretty bullish on industrial metals broadly. Gold just happens to be the king the king out of all of them, in my opinion. Just because of especially monetary debasement and the fiscal crisis, which is some of the stuff that, in my opinion, is making gold act the way it's been acting, and I don't think that that's going to stop anytime soon. Like, you know, it wouldn't shock me if gold was 3,000 by the end of the year. It also wouldn't shock me if gold was back to 2,500 by the end of the year either. So just to be clear about that, and nor would it really matter to me. Like I really wouldn't care which direction it happens to go. Like a year ago, you know, or not a year ago, but I would say like in 2022 when they were raising interest rates, I was telling everyone that I knew that was asking me questions about gold and stuff that it was totally possible that it would go back down to 1,500 when they were raising interest rates. And the fact that that didn't happen is pretty crazy to me. Like we bottomed out at like 1,600 and then went right back up while interest rates were you know continuing to do their thing, which is just just crazy to me. Like honestly, like the fact that the drawdown on gold during this rate hiking cycle was only like 30% or whatever it was, or 25% or whatever it was, like that's actually pretty impressive for this type of metal. And I think that the monetary debasement is largely the reason why. But yeah, so don't need to get into all that. But the point is, yeah, I do feel a little bit rushed to essentially complete as much of my research about gold as possible, so that I can maybe try to trade into some better positions for gold as well. And then I also hold gold ETF as well, but that doesn't really require research. That just requires holding. So it is what it is. Mr. Beast, you asked about oil. I would definitely like to do some research on oil, but it gets put into the energy basket, not with the miner basket. Yes, oil does have a lot in common in terms of like the concerns and the metrics I'm talking about. Like you would definitely be concerned about basically these exact same kind of metrics when it comes to oil, but I wouldn't group them together with the industrial metals. And I did group coal in here, like I said, but that was partially because people in the Discord were asking for commissions on AMR specifically. And I was delivering on that. And I was like, you know what? I'm already doing this other research right here. Let me just kind of like take a look and see how it stacks up, because I was curious. But once I do, maybe if I move on to look at energy and maybe do kind of like the same kind of analysis for oil, I might I would probably do oil, natural gas, and maybe throw coal in there as well and call it just like an energy grouping. So that is what it is. BHP, yeah, BHP is one of those ones that falls into the two camp. BHP is kind of an interesting company because of like how much they've evolved, which resources they've been focusing on over the years. It's like the BHP of today is like starkly different from the BHP of 5 years ago versus the BHP of 10 years ago. But yeah, I'm pretty sure it has to do with some of the Australian laws surrounding like how they have their listing set up, if I recall, as far as like their taxes. But yeah, I was pretty interested in BHP uh, earlier in the year and at various points last year. I never ended up pulling the trigger on it, but I definitely had some interest in BHP, and I mean they stack up reasonably well. They're much more of a mix in terms of like which metals they have. Yeah, it's like 69% other, which is like some of those base metals and coal, and then like 31% copper. And copper was definitely something I was trying to focus on. So like, they were kind of important to put in there. I didn't label them as one of those copper ones because you only got the label here if you had a majority of your production coming from that particular category. But they have a very strong plurality um, for copper. So anyway, back to REITs. A little diversion on that, but still getting into stuff on that. So as I was saying before, we actually have many more metrics to kind of judge them on for REITs because honestly, like I said, some sectors just have a lot of conformity in terms of like the types of stuff that they report and also the things you might care about. So the things that I chose to care about for REITs was first and foremost their credit rating. I chose S&P ratings as the one I was focused on. If they didn't have an S&P rating, but they had a Fitch rating, I put that down as well because Fitch uses the same scale as S&P. Usually, if you had Moody's, you had at least Fitch or S&P. So I was usually able to get that. It wasn't like a concern where there was companies that had a Moody's rating but didn't have the other one. But the point is, I just wanted to use this particular scaling system. But there were companies that didn't. I couldn't really find any rating for. So there are some here that don't really have anything. But nonetheless, here are the ratings. And then I just put them in order of the scaling so you can see like where the typical scale falls up. And yeah, we want to pay attention to credit ratings for REITs because REITs are very often heavily reliant on debt financing. Not all of them, but a decent amount of them rely significantly on debt financing, both for the acquisition of properties as well as just the general operations, depending on how they structure their business. So something to care about. And then we paid attention to their occupancy levels for their properties. Now we're just using their most recent occupancy. Obviously, that comes with its own concerns. Like maybe right now isn't super representative of what their typical occupancy is. Maybe they have higher occupancy than normal right now. Maybe they have lower occupancy than normal right now. But whatever, I had to choose something, so we just went with today's occupancy. Ideally, you might have wanted maybe like an average occupancy over the last 3 years or something. I don't know. That would maybe be nice, but we're keeping it simple. Then I also have the remaining lease life. So like obviously REITs have leases that are signed largely, and so how long is it going to be on average, on a weighted average basis, until those leases are up, which means they're going to have to renegotiate with their tenants, or potentially their tenants are going to leave them for greener pastures and things like that. Um, O seems like the worst. Their tenants are terrible. Well, funny you say that. We'll see how they actually do stack up in the end. It turns out they do stack up reasonably well, but it's not necessarily based off of their tenants, because the metrics I have here aren't largely based around their tenants. So you could certainly judge them on that. I'm not a huge fan of O, partially because of their tenants. So I do generally agree with you. And like I said, you would want to dig deeper. Like this is really like a starting point in terms of thinking about quality. You don't necessarily want like just go out and buy the highest rating companies on these lists. Like obviously there's a lot more you'd want to go into. So, but it is what it is. But I didn't really include any metrics super related to the tenants here, are directly related to tenants. I have things related to like how the company manages their tenants, as you'll see, but nothing super directly related to the tenants themselves. But yeah, so that would be something that you would maybe want to add on to this research, is like maybe if you look at the higher quality companies in this list, you might want to also yeah, maybe take a look at their top 5 or 10 tenants and think, how do I think their business model is going? How likely are they to be to maybe have to refinance or renegotiate or possibly default on their leases in the near future? Because that would maybe be something you would worry about. One metric that a lot of these companies do report that I didn't put up here is the average credit rating, or some sort of way of giving you a sense of the credit rating of their tenants. So I focused on the credit rating of the company itself. But that would be something you could do, is you could look at the ones, like I said, not every one of them did this, but a decent large amount of them would talk in their presentations about the credit quality of their tenants specifically. So that would be one way that you could carefully pay attention to that. Another thing that I really like that some REITs have and then other ones don't. So you kind of have to look for this in their presentations or in their 10Ks if they talk about this. But some REITs have really fine level ability to analyze their tenants on a very micro level. Like some of them only get the financials of their tenant on kind of like a total corporate level, but other ones are able to get the financials at a store level or at a unit level. I would generally say those are probably the better ones too, because it means that the company, it means that your REIT company is going to be in a better position to really understand whether or not their tenants credit quality is truly deteriorating or not, especially at that particular level. BSR is Jack's favorite REIT right now, trading at book value 10 times EBITDA. Did I have BSR on here? I'm not sure I do, or maybe are they? No, I don't think I are. But maybe I'll add them to the list, because I only have so many on this list as well, right? It's like, like I said, you have to go through the 10K and the presentation manually to get all this information, so it takes some time. So really, you can only have some on the list. I have 34 currently on the list, but maybe I'll take a look at them. Oh, they're a small one. Yeah, so that's gonna be another one too, because with the mines, I started at the top and I worked my way down in terms of market cap. So yeah, I probably wasn't there, because you can see even the ones I had that I didn't get to only went down to like 3 or 4 billion. So yeah, obviously, but yeah, maybe I'll take a look at them. Because yeah, this is just a starting point for the research. This isn't an ending point or anything like that. But anyway, remaining lease life here. Now, as I was kind of talking about in terms of the type, um, I'm gonna talk about that first, because honestly, it's pretty relevant to talking about a lot of stuff. Now, the type of real estate that they do is going to affect things pretty significantly for some of these metrics. So unlike with the mining ones, where like I said, the metals, I thought maybe it would matter a lot which type of metal I was looking at, but then I found that the statistics really wasn't shifting that much depending on which metal I was looking at. So I kind of was like, whatever, I'll just kind of combine them all together. I still sort of wanted to combine them all together for the REITs, but I still found that there was some significant differences, in particular for one of the metrics I chose to use, which is the price per month per square foot, the rental rate per square foot on a monthly basis for the properties. That varies very significantly depending on the type of real estate you're doing. And also there are some models, some business models in here that really don't conform with that way of thinking at all. Like for example, hotels, as well as certain types of medical facilities really don't report things, like they're not really the same. It's not really rent, right? Like there's certain categories that it's not exactly the same. Same thing for mortgage REITs as well. So I did kind of have to essentially make some kind of like attempts to convert similar metrics into a metric that would work for this comparison. But that gave me some pretty strange results in some places. So like, for example, if you're looking at the price per square foot column here, a lot of them hover around like $1 to $2 or so. Like that's a pretty typical normal level. But then there's some very, very strange ones that stand out as much larger. And then I kind of bolded them so that I would know there was something strange going on there. And it probably has something to do with whatever their metrics actually are there. Um, who's the cheapest and the most expensive per square foot? Well, like I said, I would only focus on the ones that are much more cleaner examples and don't have any of those kind of strange attributes to them. But within that space, the ones that don't have strange attributes to them, um, some of the highest ones are DOC, GLPI, HR, and those ones are all relatively specialized forms of real estate. That's something you'll notice there. They're pretty, and that's, like I said, part of the reason I was paying attention to the type of real estate, because yeah, there's very significant differences in the types of prices you can charge per square foot, depending on how specialized the type of the real estate it is. Healthcare, gaming, um, hospitality, those are going to have much higher rates versus industrials generally going to have some of the lower rates. If you think of it this way, like an industrial commercial property, you can largely just deliver them a big box, right? They just need a big old warehouse to function out of. You don't really need something super specialized in. Whereas like even retail, you might need a lot of much more specific things like that. Um, and then you're asking, is the thesis that they might drift to a lower price per square foot? Well, okay, I'll be clarify here. I'm not treating the price per square foot as the actual metric that I'm giving them the quality metric on here. You'll notice like I didn't highlight anything in this column for the price per square foot. It's this next column over where I have the highlights, and that's because I did something kind of particular here, because of the fact that I knew that there was going to be significant differences in the types of square footage charged depending on the type of real estate it was. What I chose to do is I used my type of real estate measure, because I did give them a score for the type of real estate it is, because I want to focus more on specific types of real estate because certain types of real estate conform with my themes better. So like I'm much more interested in housing, and then and both mortgages and multifamily are both pretty sweet in my opinion. And then after that, I'm pretty interested in industrial, and then after that, I'm pretty interested in retail. And then after that, I put specialty. Technically, some specialty are better than others. So like some specialty, I would rank higher than that, and some other than that. So I just kind of put it in this space here because I found that I thought that was going to be a good metric for specialty as a broad category. Like I said, specialty can mean a lot of things. And then office, I put in the worst bucket, because everybody knows the issues with office. So, which incidentally, there wasn't really a whole lot of. Frankly, there was very little office showed up in the list for these first 34 or whatever REITs that I got through. So it was really more largely focused on the other categories anyway. But the point is, I use a scoring method for that, where I have a weighted average score for these, depending on how well they conform to the category that matters to me. And then what I chose to do for the square footage thing is I took the square footage I came up with for the metric, and then like I said, some of them I kind of had to make some adjustments to try to make less conforming versions of the metrics work well with the others, and it still get me some strange results. But the point is, what I did is I then used a linear regression to forecast what the square footage would be based off of the whole data set, based off of the type. So if it got a score of a 2 in its type category, then it would look at basically all of the different types and all of the different price per square foot, and it would give me a linear regression guess at what type of price per square foot we would assume that category would get. And then I subtracted the difference between the actual one and the forecasted one. So that's what this column is here, the trend deviation. So that's actually what I chose to score it based off of, because I wanted to, and I chose to think of something as high quality if it could charge higher than what it's expected to be able to. Now, you could make an argument both ways about this, because you could make an argument that maybe you would want to go with the ones that have the lower level, because maybe that would give them the highest opportunity to raise rents in the future. But I'm going to assume that there's a qualitative aspect in why they're able to charge the higher rents. So basically, in this column here, anything that appears with a positive value is something that has a positive deviation from that trend, and that's where it got the point. So that's how I chose to treat this particular metric. Like I said, you could totally argue about that. You can make some solid arguments about multiple ways. I kind of went back and forth in my own head about how I wanted to handle the whole square footage concept in terms of thinking about quality, but that's what I chose to do. I chose to say, okay, what would I expect their price per square foot to be based off of the type of real estate they are, and then what is their actual price per square foot, and then how does that deviate? And then I'm choosing to think of companies that are charging higher rates as potentially having some sort of qualitative aspect that makes them capable of charging those higher rents. Maybe they have better locations. Maybe they're in better areas. There's multiple things that go into it. Like I said, you would want to dig deeper. You don't want to take any of these things as like some gospel. There's probably reasons and things you might want to look closer at everything. And then, like I said, that's only one metric. For the miners, we only had three metrics for this qualitative approach here, whereas for the REITs, I have like eight of them. I have a lot more metrics going on here. So this is just 1 point out of eight that they could theoretically have earned, which means it has a lower impact on the end quality score that these REITs end up getting. So I was willing to accept my kind of strange methodology I used here for that. So anyway, coming back to that. Oh, well, I did tell you those first few that had some of the higher rates. Some of the ones that had the lower were, like I said, industrials, PLD, Stag, STWD, WP Carry. Those are some of the ones that ended up popping on just the pure lowest price per square foot. And like I said, you'll see industrials down here and some retails down here, and then you'll see specialty up here, as in particular. Specialty typically hits up near the top. Anyway, continuing on some of those other metrics, let's reorder it by the final score. So anyway, I said the S&P rating, occupancy, the remaining lease life, which we were talking about how the remaining life of the line could give you a direct sense of how to give a terminal multiple for a company, for a mining company. I wouldn't say that's necessarily the case for REITs. You could kind of assume that would maybe be the case because of remaining lease life, but with REITs, obviously people can renew leases, whereas with mines you can't just renew the life of the mine. So it's not really the same kind of metric, but the point is it does create a risk for you. So we obviously want companies that have a larger length of time remaining until they need to renegotiate their leases. If it's higher than 10, that would be even more ideal, because we use 10-year projection periods for our DCFs. And so that means that essentially you don't have to worry about that over the course of your time frame. People can still break leases, but then there's legal fees and stuff and complications in there. And honestly, they may not even be able to, depending on the contract that they sign. There could be legal limitations on that too. You could be forced to comply with the contract that you had originally signed. So anyway, the next column, the next thing that we gave points for was rent escalators. If they have contractual rent escalators, which means that it's in their contract that their rent is going to go up 2% per year or something like that. We really like that. That's sweet, right? Because that means that you don't have to wait to the end of the lease for the prices to go up. It means that there's, on a contractual basis, the rents are going to move with inflation, and oftentimes it is with inflation that they have the contractual rent escalator. But if and for the record, if it said that they have a contractual rent escalator with inflation, I use 2.5%. That was what I would put down here as the number. But then other ones just had static numbers to it, so you can see that here. That's what I chose to put here. And then there was plenty of them that had nothing there, so you can see there's a lot more blank spaces in some of these columns than other ones, which means, frankly, that they just don't get that point. You know, if you don't give me the information, you don't get the point. So that sucks for them. If maybe they did have higher quality attributes, well, then maybe they should be telling me that. You know. Next column, we have the top 10 percentage of rent. So their top 10 tenants, what percentage of their total rent does the top 10 tenants take up? That's what this column is, which means in this column, you would actually want to have a lower number, right? Like that would be something you would want, is you want less concentration into your top 10 tenants as something that we would think of as higher quality here. Vici, Vici has less than 10 customers. So, you know, rough for Vici. But, you know, other ones have much lower. I put 0 down here. If I'm remembering, this is a mortgage REIT. And so effectively they have like a ton of tenants. I don't actually know what the exact percentage is, but the point is it was probably like a fraction of a fraction of a percent. So I just put 0 down for that one. But it's not literally 0. It's probably like 0.1% or something. I don't know. You know, something probably less, honestly. But point is yeah. So it can vary a little bit like that, but 19.1% was the median value for the ones I looked at, which is kind of interesting. So then beyond that, we did do geographic some geographic disbursement of their assets for this particular sector as well. Now, this one is largely focused on the United States because I'm largely focusing on US REITs. There are REITs in here that have international exposure, but I basically just bucketed all of international into one category. And then I pick and chose the regions that I like in the United States based off of my own view of the economic dynamics over the next decade. So, you know, if you have your own preferences, that would give you different conclusions. So, you know, like I said, this is research to serve my purposes. You know, there's going to be some subjectivity in how I handle all these things. But for me, in terms of the United States, the Southwest is the place to be, in my opinion. And then beyond that, the Southeast is the next best place to be. And then beyond that, the Northwest is a reasonably decent place to be. Some parts of the Northwest are better than others, in my opinion. And then the Northeast, then the North Central, which is kind of like the Midwest, but it includes a bit more of like the more Western section of that too. So like these are the categories. The way I chose to split the United States up, I split the United States up into 5 categories. Which state is in which category? People might argue about. Some states I kind of split down the middle a little bit, and a lot of these are kind of rough estimates because the way they reported their information wasn't super precisely in my categories. So I in a lot of these cases, I just kind of gave like a rough estimate based off of what it looked like. So it's not even super precise, but the point is, it's just going to give me an idea. Where do they have their assets? Do they have their assets in places where in metropolitan areas where I think are more popping? Like to me, in my opinion, basically the southern band of the United States from like Arizona to Florida is like the place to be. But that's my opinion. Not everyone's going to agree with that. You know, I'm personally pretty bullish on the Sun Belt, but other people might have a totally different opinion on the preferable dynamics geographically in the United States. So that is what it is. And then we have like a weighted average scoring for that as well. So those are all the metrics. Like I said, we end up with 8 different metrics for REITs. And then we have the list over here. The median score was a 3. So you can see the 3 and above being listed, but it's worth noting that like for the minors, if I just did median and above, it really only got me like slightly more than half of them. And there was like, what is that? 20 of them were median above, whereas 17 of them were below median for the minors. So it's close to half, right? Close to half. Whereas for the REITs, 3 and above is 24, whereas it's only 10 below. So, you know, maybe you would want to only do above median, which would be 4 and above, which would get you 14 companies to look at. But anyway, I chose to be consistent with how I highlighted the scores as I did with the minors. But you could argue that maybe, and like I said, like I mean, my plan with this is to just start at the highest scores, go look at their management teams, go look at their assets, see if there was anything that was weird about it that made the scoring system kind of throw it off a little bit. So like maybe that score isn't super accurate for some reason or another. Because like for example, right here, FRT, which I'm pretty sure was Federal Realty Trust, they got a perfect score. They got 8 points. That's pretty sweet. Pretty sweet. But I don't know. Maybe once I look closer at it, maybe there'll be a lot of little details in there that kind of made my my assessment here skewed for some reason or another. It's worth noting that they're one of the ones that has these figures bulleted here. So that means I made I had to make some assumptions about their price to per square footage because of the way they reported their information. So maybe those assumptions I made were totally off. But like I said, that would have only affected 1 point for them. So even then, they would only have a 7 if we discounted that 1 point. But then maybe I don't know. Maybe you want to look closer at their tenants, as Jack was pointing out. It's like you really want to pay attention to who the tenants are, and this analysis doesn't really pay much attention to who the tenants are. At best, it just tells you where the tenants are, right? Like that's like the only thing that this analysis at best in terms of the tenants gives you information of, and it tells you how concentrated they are in their tenants, but it doesn't tell you who they are. So maybe if you look closely at FRT's tenants, maybe there's going to be some seriously hairy ones in there that's going to really throw off your desire to look closer at them. But the point is, I'll start at the highest scores. I'll work my way down, see if there's nothing screwy that really kind of throws off the analysis, and then go look at the management teams. Go try to narrow in on some best management teams. Maybe I'll look at all of the fours and above, which is, like I said, 14 companies. Maybe out of those 14 companies, I'll find 5 management teams I like. And then maybe out of those 5 management teams I like, maybe I'll find 2 or 3 that have reasonable value to them. And then I'll throw them on the list and wait for them to get to a preferable buy target. So that's kind of that's my process. That's my approach. I kind of showed you it with the miners and the REITs. I'm planning to do this for more industries going forward, but I'm also trying to not get like too far ahead in like how many of this exact type of analysis I do before I do the digging deeper. So I like, for example, I plan to do this with utilities next. That's one of the, like, if you come back over to my themes page, utilities was one of those ones that was showing up here in several different places. So I plan to do utilities, and I'm partially one of the reasons I want to do utilities is because like the basic materials sector and the real estate sector, utilities has a lot more conformity in terms of the stuff that it reports. So it might be a little bit easier to do an apples to apples comparison in utilities than it would be to do in like discretionary consumer spending and stuff like that. So I think it'll be easier to me to do some analysis in utilities. And then I'm also curious to see what kind of results I get there. But so I'm going to do this with utilities, but at the same time, I do need to kind of get, like I said, going on the close analysis, the management analysis of the miners. I don't want to do this analysis for like 10 different industries without having gone to the next step yet in the process, because the goal is to start building up a watch list of things that we would like to own that we're maybe just not quite ready to own yet. See, like a lot of my approach, as I said, coming back over to like the previous approach, a lot of my previous investing approach has largely been find something that's cheap and then find reasons to either like it or not like it. And I kind of want to reverse that process. I want to find reasons to like or not like companies and then wait for them to get cheap. It's like I'm trying to reverse the process. It's like waiting for your pitches rather than swinging at everyone that comes your way. That's kind of, to give it a baseball analogy, so to speak. So let's see. Well, we made an hour and 47 in to get all that stuff done. I don't know if anybody had any more kind of questions about this process or any other kind of like follow-up things they wanted to throw at me a little bit. Like I said, utilities was one industry I'm looking to do next. Then after that, I would like to do kind of a similar process with home builders. I would also like to do it with like building products and construction generally, but home builders and construction and building products would kind of have to be done separately. Like home builders are more like the next step in the process to the home builders and construction stuff, but both of those fit into my themes as well. So utilities, builders, build products slash construction, like those would be 3 more categories I would really like to do this on. Let's see, what else would I do? Oh, electrical equipment would probably be one I would want to do after that. Electrical equipment will definitely be a little bit more varied. Like that's probably why that will be maybe one of the last ones out of that list I get to, because that one's gonna not have quite as like well conformed metrics. See, like that's the thing that made like miners easy, is because if I'm doing miners, they all have resources. They all report their resource levels. They all report their sustainable cost levels. They don't all report the years of their life left, but you can calculate that based off of their production levels and their resource levels. So it's an easily acquirable metric. REITs basically all report occupancy, right? They basically all report the rent revenues, and they basically all report square footage. Like I said, there's some of them that don't necessarily report square footage, and you sometimes have to kind of do some calculations to figure that out. Like for example, some of them only reported things like rooms or buildings or properties, and so that's why that's kind of what I mean by like I had to make some assumptions somewhere sometimes to get some of these metrics. But the point is it's close enough that you can kind of do a pretty broad kind of qualitative analysis like this because you have very similar metrics. By the time I get around to electrical equipment, well, I mean, electrical equipment isn't going to really give me super consistent metrics across all companies. So it might be a little bit harder once I get there, which is kind of why I'm waiting to get there. I might be able to do some sort of like comparison of like how many customers they have, how many products they have. But at that point, once I get to electrical equipment, it's probably more likely that I actually will have to rely more on actual financial state information. Because as I was kind of pointing out here, a lot of what I did here didn't rely on financial statements at all. Like a lot of this is kind of just like non-financial metrics. With the REITs, technically I was using the rent revenue, which comes right off of the financial statements. But it wasn't because I wanted the rent revenue. It's just because I wanted the price per square foot, which isn't really that same metric, right? So it was like, that was kind of the closest I got with that one. And then like I kind of said, like all-in sustaining cost was the closest I got with the mines. With electrical equipment, it might not be so easy to use non-financial qualitative measures like that. So I don't know. Well, I haven't done too much thinking in terms of like which metrics I would do for that industry. Like I said, I have a whole handful of other industries I kind of like to do this with. And then, like I said, I'm also trying to go to the next step of looking at management and creating this kind of like watch list of higher quality, higher management assets to pay attention to. But here you can see this is what I mean when I say focusing on quality and trying to rank quality assets. So I hope everybody enjoyed this. This is what I've been working on the last couple weeks. We'll probably stream again in 2 weeks. You guys may have noticed that I was streaming here on a Friday in the middle of the day, which is not super typical for me who does work uh, a 9 to 5 Monday Friday job in commercial banking. But I am taking off every other Friday basically for the rest of the year. So I was like, hey, why don't I actually stream on Friday? I don't really get to stream during market hours very often. So I was like, hey, that might be kind of fun. Not that it being market hours necessarily affects anything that I talk about because we're not out here day trading, right? But hey, speaking of which though, let's take a look at the market. We were up a lot more earlier. What happened? We went from 1% up to only ending at 0.4% up. I mean, I'm okay with that. I was kind of hoping it was going to be another down day anyway, but interesting to see nonetheless. Um, Taking a look at stuff. Lulu, out of all my holdings, had a very, very nice day today. Up 7 to 8%. Pretty nice. Taking a look at the who's reporting. Let's see. Exxon and Chevron reported this morning. Maybe take a look, see. Missed 4% on revenue, 2% on earnings for Exxon. Beat on both revenue and earnings for Chevron. So interesting. Good for them, I guess. Taking a look. My portfolio. The next thing, let's see. I've already had PayPal and InMode and Generac report. I already listened to the PayPal and InMode call. I need to listen to the Generac call. Still, I'll listen to that probably later this afternoon. But the next company that reports in my portfolio is Heidrick and Struggles on the 4th. Interesting to see what happens with that. And then Mastercraft after that on the 6th, along with Fidelity, National Financial, and FG. I know it was called out that FG was coming down a little bit. I was asked in the Discord whether or not I was going to be buying sub 40, which I mean, generally sub 40 I think is a pretty sweet bargain for FG, and I've been buying sub 40 at various points throughout the year. So I mean, yeah, I might buy more. And like I said, I've been very, very slow in nibbling with my purchases lately, partially because I'm trying to get as much of this research done so that I can start buying things through this process instead. As I kind of said at the start, the end goal is to get much more comfortable with concentrating a lot more. That's really where I'm trying to get to. That's the real goal of all of this, is to get to a point where I can hold less and less holdings and much larger concentration. You may notice just how much cash I have right here. We do trade back and forth between holding VU and holding massive amounts of cash, depending on certain liquidity signals that I pay attention to. So we're currently at cash, and we've been at cash for a little bit of a minute, which is one of the reasons why I was hoping it was going to be a down day today. So, you know, is what it is. But the point is in an ideal world, I would have a low amount of both of those. You know, I would have solid allocations to individual holdings instead. But the point is that this is what I do as trade back between cash and VU if I don't have companies that I want to allocate overly to. And by the way, I know I had just come up with a new allocation system somewhat recently, but I'm already kind of like ignoring it and discarding it and rethinking it anyway. Because like I said, this new allocation system you see right here was before I started doing this research, and the point of this research is to start concentrating. So I don't know, I'm gonna rethink my allocation system yet again for like the fourth time in 2 years, probably. So hey, what it is, I'm constantly evolving. So yeah, that's I think pretty much all I've got for you guys today. Seems like you guys didn't have any follow-up questions on the research and stuff. So all right, I will catch you all in 2 weeks then. Maybe we'll do it on Friday again. Seems like a handful of people were able to show up to the chat this time, so maybe actually doing it in market hours on Friday is not a bad idea. I don't know, but I could theoretically do it basically at that same schedule for really the rest of the year, because like I said, I've already scheduled vacation days basically throughout the rest of the year, every other week. So doesn't mean I would do that necessarily all of next year, because I wouldn't necessarily want to use all of my vacation days that way. But I had extra vacation days that I had to use by the end of the year, and so that's kind of what I chose to do. So all right. So anyway, thanks for coming and chatting, guys. Those of you that showed up in the chat, I appreciate it. I'll say again, for anybody that watches on the replay, please like the stream if you enjoyed what I brought to the table. Please subscribe to the channel if you haven't already. Please join the free Discord. Link is in the description below. And give a peek at the public dashboard link. Like I said, this is now free to access for anybody who's a member of the Discord. It doesn't give you the ability to go in and look at the finer details of the valuation. You would have to pay a $5 subscription for that, but it at least gives you this main page where you can see what my values look like as they move up and down, and the changing of the coggers, the changing of the percentiles, as well as all these other metrics that I'm either calculating or importing from various locations. So if you want to keep track of the things that I have on my list on any given day, you can get at least this page for free just by being a member of the Discord. So I'll catch you all in 2 weeks.